We'll go ahead and start the meeting, the Sheriff's Merit Board, November the 18th, 2020. We'll first start with the pension meeting, and I think Elaine's there, right?
Yes, indeed.
And Greg, I heard Greg Gelser's there too, right?
Yes, I brought Greg and Don Hutchinson with me as well.
Hi, Don.
Hey.
Okay, you go ahead with your presentation.
Okay, thank you. Greg, do you want to start us off, please?
Well, sure. Well, thank you everybody for having us, Sheriff. Thank you very much. Merit Board, for those that I have met in the past, good to see you again. For those I haven't, and for those guests here this evening, by way of background, I'm Greg Gelser. I'm the CEO of Gelser Investment Management. We're a firm located in Indianapolis. We're 51 years old, and we are an investment advisory, consulting, and asset management firm. We work with institutions and individuals. On the institutional side, we work with 31 of the sheriff counties around the state of Indiana, as well as a number of endowments and foundations as well, such as the United Way, Fairbanks, Kiwanis, WFYI, to name just a couple. Our firm, we're 30 strong. We represent and manage a little over $2 billion in assets, and we have 700 clients in 55 states around the country. But what a year we have had to work with. You know, we started off and the market was an all-time high. We're introduced to a pandemic. The market shuts down and the economy shuts down overnight. We have protests, we have riots along the way. We have a presidential election. We now have a new administration in Washington, and we have a vaccine, forthcoming. And so quite the year we have had, and I can't tell you how proud I am of what we've been able to accomplish. In February of this year, as this was all coming about, someone at a Merit Board meeting asked me, where are we going and how long is this going to take? And my response was, I have no idea what's ahead of this, how long it's going to take. But what I do know is that we're going to successfully navigate ourselves through all of this and look back and no differently than we have over our past 50 years at these sort of things as well. And whether that was the recession, whether that was other pandemics, whether it was terrorist attacks on our country, we navigated successfully through. And so I'm very proud of what we've been able to accomplish over the last 9 months. Looking back, it seems easy. Looking forward, I still can't tell you where we're going, but I know that our team is as strong as it's ever been, and looking forward to continuing to serve you. And so today I'm here just to say hello, to introduce our team, but to also let you know that we are committed to the law enforcement community by way of the 31 counties that we are representing, as well as our support of the Indiana Sheriff's Association. And as you are protecting those in your community, I just want you to know at all times we're protecting your assets, and we are here to answer any questions that you might have, as well as take ideas as how we can serve you better as we move forward. And so look forward to continuing our relationship, and look forward to our presentation yet today.
Hey, thank you.
Thanks, Greg. Don, do you have the presentation that you'll be able to bring up on the screen and kind of walk through that with us? Okay.
Absolutely. I'm going to bring that up right now. Does that sound good?
Yeah.
Oh, I've been disabled. I need to be enabled to share my screen. Is there a way to do that?
Oh, yeah, I was taking care of it. There you go. You should.
Yeah, that was quick. You're good. You're fast. Here we go.
Hey, Andy, we are recording this, right?
Yes, sir, we are.
Okay, thank you.
Hopefully, can everybody see that now?
Yes.
Yeah.
Wonderful. Okay.
I will start off with, again, introducing Don, as you've seen him here more recently than, say, Greg. But again, as he is the managing director of our institutional advisory services, thought he would be very well, he would be the person to come and talk the most and have because he has the greatest experience on what's been happening in these markets and in that leadership role at our firm with, of course, managing your assets. I don't know if, Don, do you want to talk a little bit about the commentary on the capital markets from the third quarter, or shall we move forward beyond that?
Let me just make a couple quick comments. I think as Greg mentioned, there's a lot of uncertainty out there in the markets. There's been obviously a tremendous amount of news flow, especially the last month or so, but wanted to just maybe summarize a couple things that we know are coming. At the pace at which they're coming, we're not sure, but we are getting more and more confident, and the market is getting more and more confident that there will be an end to this pandemic, given the news, the great news we've had the last 2 weeks in terms of the vaccines. How quick and how efficiently we can distribute those vaccines is yet to be seen. But the reason you're seeing such a rally in the stock market, the equity markets, really right around the election and into really earlier this week is because of the thoughts that we will be reopening and this economy will be really coming on strong, probably in the second half of next year. And the markets always tend to look forward 6 to 9 months. They're always looking ahead and sort of discounting what that news is. There's an old saw called, you buy the rumor, you sell the news, if you will. And they're really buying the rumor today, and that is that we are going to reopen. So I think there is a lot of, if we can get past this surge that we're in right now and get through that, the spring, I think will bring better times. The biggest challenge, I think, for the next 10 years, really the next 5 years, for all pension funds, as well as this one, is going to be low interest rates. We remain in a very low interest rate environment, and that means that a lot of the work we've been doing at Gelser the last 6 to 8 months that I've been involved with is trying to come up with some strategies that will help us navigate this low rate world, if you will. We'll talk a little bit about that more. The last thing I'll just mention real quick, and then we'll get into the review, is we're just coming through corporate earnings season. And why that matters is because companies come out, the stocks you're invested in, those companies come out, report their earnings, and we've had much better news than I think a lot of folks expected. In fact, 70% of all companies have beat expectations. And the resiliency we've seen in corporations and their earnings has really been tremendous the last couple of quarters. And the news looks much better as we look out into 2021 in terms of earnings growth. Even with the new administration, even with the potential for some more corporate taxes, we're expecting earnings growth somewhere in the ballpark of 20 to 25%. So that is a really good underpinning to these markets. And the last thing I'll just mention is the big bank, the Federal Reserve, has come out. They just came out as recently as yesterday saying, we have this market's back. We will continue to provide liquidity and backstops to get us through any economic disruptions that occur here over the course of the winter time. So with that, Elaine, I'll bounce it back over to you.
Okay, thank you. That just the pie chart. Here is the current asset portfolio, the allocation, and this is as of November 13th. It shows that there were, 15,162,000. Oh my gosh, I need my readers. 388, 102, 388. And again, showing that the current positions for cash, equities, fixed income, and alternative assets are within the parameters between the minimum and the maximum. They're not it's spot on to the target, but again, just off by slight variation.
Yeah, let me just mention real quick, Elaine. I'll just mention something. You can see we're overweight stocks a little bit, and we're underweight bonds. We're pretty much right on target with the liquid non-traditional, and there's some design to that, and it's very difficult to find any bonds with any kind of yield today. And stocks, quite candidly, are yielding better than bonds, but their return profile is better as well. So we've decided to overweight stocks, and the run up in the market has caused that overweight. And then we've decided to underweight bonds at this point until we can find some better opportunities.
Okay, thanks, Don. Looking below that is a table that categorizes by the asset class how the returns have been for the past quarter. Now that would have been the third quarter. In the first column, showing that the blended portfolio had a 5%, a little tick over 5% return for that quarter. Then the next column to the right shows quarter to date. Now that would be just for this fractional period that we're in right now with the account value as of Friday. That doesn't take into any consideration what's happened this week. But the next column, which is really a value in terms of just thinking about what the valuation is going to look like at the end of the year to date. We've already been able to take it above the 6.75% mark. As you know, hang on to that as we approach the end of the year. That will be fantastic. But again, the 6.75%, that's what we're shooting for. But then there is that column at the far right, and that is looking then at the inception to date. And again, it's using an inception date of when the asset allocation was fully implemented as directed by the investment policy statement. So the first quarter for which that was fully implemented was June 30th, and that shows there the net return on an annual basis of 10.48, which is a pretty good number, a real good number. Don, if we could move to the next page, unless you have other comments about some of these individual asset class returns.
I think we're good right now. No, thank you though. Yeah.
Okay, all right. The next page we've added is the snapshot for the benefit plan. Now, we know this is a much smaller account. It has less obligations for payouts and what is owed to the membership. And so, again, $874,000 and some change, but it's still a significant size fund. And it is invested much the same way with the asset classes showing there that a little bit on the percentage of cash is maybe a little bit higher than the other plan, but with the equities, fixed income and alternative assets, very similar in the allocation, just as Don talked about the underweight and the overweight, waiting for opportunistic investing there. Again, looking at the past quarter return, 5.21, again, very close to what the other plan showed. Quarter to date, and again, this is just for this partial interim, and year to date being 8.6, again, very much along the same lines, because the assets are invested very much the same. Inception to close being 11%, which again, a little over 11, a good number, very good number, strong number. One of the things that we wanted to do in this quarterly meeting, beyond an update of the performance and where the markets have been and things like that we would traditionally do, is we want to once a year provide to you a fee study. And what that means is that we take a look at what the fees are currently being paid by the plan for the investments and for administration and for that, to see if they are in line with what's industry standard, and also to divulge that to you, so that we take a close look at what is being paid by the plan above and beyond the obligations to the membership. So these are the results, and Donna, if you could flip that page. And we've summarized this in a chart. And again, these are fees associated with the investment and the ongoing administration plan. We've separated into the fees that are necessary for the investment function. And so what we've shown here is that the investment manager fees, these are for what's being paid or what is charged by the investment managers for the mutual funds. And so collectively over the last year, that amount was $47,000, a little above that. And then the weighted average being, as an average of the entire amount, 0.31%. Those are there for everybody. You can't really get away from them. It's just the nature of the beast. The next one shows what Gelzer's advisory fee is, and what you're getting for that is our advice on the strategy planning, asset allocation, investment policy, manager structure and selection, implementation, and ongoing monitoring of the funds. The total fee pay $84,042. That is based on a blended scale, as you recall, that is a certain percentage for the first chunk, and then the next chunk goes at a reduced, so that the more assets in the fund will be at a lower rate charged. But there again, 84,000, and that being a weighted average of 0.55%. There is a custodian, that is Fidelity, and they're holding the assets. And they charge only when there are movements in the assets to execute trades. And that really is a nominal amount of $370, 0.01%. So for the investment function, 132 to 24, which is about 86 basis points. Don, do you have comments on your experience with foundations and some larger plans or plans of like size as to where this falls in the marketplace?
Yeah, yes. I think, when we look at a couple different ways we look at this, when we look at plans sort of in that $10 to $25 million range, which you all are at, we see all-in fees like this under 1%. Okay. Typically we see the average being closer to 1%. So you guys look really competitive from that perspective. I would also just note, when I look at RFPs that we get and, the things that get bid on and what have you, the 55 basis points for this work, plus what's not listed here is the bond management we do for you and some of the core equity management we do for you. That's included in that. So we don't charge any investment management fee like this for those services as well. So that looks really competitive as we see RFP activity. So this looks really good to me. I think what you really want to see is something under 1%. You guys are well under that. So I think, for all the investment program fees, I think that's a really good looking number there. I think we'll get into, you'll see, we'll break down all the asset investment management fees by asset class and by fund, so you can see how they compete or how they fare versus the Morningstar study. And it looks really good from that perspective as well. So.
Okay. And before we do move into that more detailed listing of the fees and comparison with the Morningstar, below there's a section that's the administrative fees. And because this is a retirement plan, there are some added responsibilities in here. Comerica Bank serves as trustee. And that means they're the ones that issue the pension checks to the pensioners and beneficiaries, receives the checks for deposits, and does the reporting statements for One America, the McCready and Keene, also things I'm sure that you need for State Board of Accounts, et cetera. But anyway, their fee looks at $12,282 for what they do, 0.08%. I did reference One America, that's McCready and Keene. They're the actuaries for the plan. And it's our understanding that right now that fee is paid outside of the trust. It is paid out of your budget, Sheriff, as a separate line item, or maybe netted out of the county contribution made to the plan. It's completely okay if the trust account pays that fee. But the way you're doing it is fine as well. The $13,828 is again what their fee is, 0.089%. And so adding that together, $26,110 for 17 basis points, which again, you have to have the trustee and you have to have the actuary. So those are some of those just fees that are associated, unintended. So. Any questions or comments or anything on that? No, we good? Okay. This now is the more detailed by category and weighted averages for the retirement plan. There will also be one for the benefit plan that Don referenced, that is detail about how the managers or how the asset class investment compares with the Morningstar universe. Do you want to explain a little bit, just one of these? We don't need to go through them line by line. Agree?
Yeah, okay. Absolutely. So I'll just start at the top here and just use this as an example. Brown Advisory Growth Fund is a U.S. large cap growth manager. Okay. And so we list it out here. And then we show you is the weight in the portfolio. So it makes up about 10.5% of the portfolio. The embedded fund level fee in that mutual fund is 0.7%, so 0.7%. And then so what we do is we compare that with the 2019 Morningstar study, and it looks at similar funds in that asset class. And it just happens to be that the average for the 2000 study is 70 basis points too. So their fee looks very competitive and right on average with the study, the Morningstar study. And if you go down the list here, you can see we've just sort of calculated out the difference to show you that all your funds or ETFs or exchange traded funds you're using look very competitive. Some are a little bit higher, some are a little bit lower, but all in all, we're very pleased with, there isn't any, outliers that we're concerned about at each individual fund level. Okay. Last thing I'll just mention here is you do use the Gelser dividend strategy. Like I said, your fee for that is within our advisory fee. So you have no embedded fee here. You see that? And that's really efficient from the perspective of there isn't two layers of fees. And then I would say it's sort of similar here, down here, the Gelser fixed income. There's a small fee there, and that's just for some of the funds we use within that strategy, but that looks really competitive. Probably most importantly, and the last thing I'll just mention, anytime you add alternatives to a portfolio, people get concerned about fee level, right? Some of the alternatives can be very expensive. Your Gelser liquid non-traditional strategy, the funds we use in there, the embedded fund fees are 0.87%, where the Morningstar study is 1.19. So it looks very competitive as well. So we're pleased with the selection. And when we select funds to use in clients' portfolios, we look at fund level fees. We look at those to make sure they're competitive because chronic underperformance is usually a byproduct of high fees, amongst some other things. So this looks really good. I would just summarize this by saying this is important for you all as fiduciaries. And I think we talked about this when you hired us, to just do this once a year to make sure everything looks really in line and competitive. And it's one of the things that we bring to you, some of the work we do that's above and beyond just picking stocks and bonds and picking funds for you.
Okay, thank you.
You're welcome.
I do have a question in regards to the weighted averages and kind of the holdings and different things. So, for instance, on between the Brown Advisory Growth Equity and also the Gelser Rising Dividends, that's about 20% of our portfolio. How do you decide, what fund that's going into? I mean, especially with, and I'm not from that world, so I don't know of the Brown Advisory, but I mean, how do you, instead of going with like a Vanguard fund or a Fidelity fund or something that might be larger, how do you decide to go into those funds?
Yeah, that's a great question. So what we subscribe to at Gelser when we put together a portfolio like this is we think there's some really good efficiency in having like a iShares S&P 500 index fund because it's very cheap, as you can see there, 3 basis points, and its goal is just to essentially keep mimic or represent the S&P 500 index out there, if you will. And so if the S&P 500 index is up 5%, it should be up 5, and down 5, it should be down 5. So it's a very efficient way to get large cap US stock exposure. The reason we would add a Brown Advisory as an example, now that's an active fund, and they are investing in the highest, most promising growth companies in America. So they're not going to behave, it's not going to behave like the S&P 500 index, but we want exposure to some of those great companies, right? And really the last couple of years has really shown that off. We want to have exposure to Amazon and Apple and Microsoft and things like Zoom, right? Like we're on today. And so that fund is very focused on those high growth companies. And so that gives us some exposure there. The dividend strategy gives us exposure to some great cash flow, dividend aristocrat companies that pay out a lot of their profits and dividends And that means that goes to you all as shareholders in those companies. We like that profile of having really good, rich cash flowing companies that produce some of that dividend flow. So as you sort of can tell here, and then the last one is the Russell 1000 value. That's really looking at companies that are really cheap, much more driven by valuation. And we want to have some exposure there because things happen like happened the last 2 weeks. And what we're seeing is a massive rotation out of the growth names and into the value names as people get more and more, I think, encouraged and confident that this economy is going to open up. And some of those value-oriented names that tend to be more tied to the economy start to do better. So what we're trying to do, as you can sort of tell, is complement a bunch of different types of investment styles or different industries, different sectors within the U.S. stock market within this portfolio construction. I will tell you that I probably of any of these that I'm most, sort of concerned about is people think that they have really good exposure in their 401k with the S&P 500 index. And my concern with the S&P 500 index or having too much of your portfolio in that right now is that it is really concentrated amongst 5 companies. It's not as diversified as people think it is. Those 5 companies make up 30% of the index because those companies like Amazon and Microsoft, they've done so well the last 10 years, they're a bigger percentage, right? So I think it's important, and if you take this away and you look at your 401k when you get home, is you might want to start to get a little more diversification within your large cap portfolio and maybe have some S&P and then have some other things that complement it as well. Did that help a little bit?
Yes, thank you very much, Don. I appreciate that.
Yeah, no problem. As you can tell, I could talk about this for hours, so just cut me off. Elaine, you know best. You know how to do that.
Next thing. No, I'm just kidding.
Right. Okay. Anything else you wanted? Yeah. Okay. Last thing, if it's okay, Elaine, I'll just jump in on here because we'll keep this real quick. But one of the things we wanted to also show you all, and we're not going to go through all these pages, but we do really in-depth due diligence on all the managers or all the funds that we use in the portfolio. And some of this is sort of peeling back some of the layers of the onion and letting you guys sort of look behind the curtain a little bit on what we do back at our shop. But we evaluate those managers, and just for your perspective, know that there's a very robust process, both qualitative, which looks at a lot of these criteria. We're always looking to see, did a manager lose a bunch of professionals to a different firm? Are they gone now? Should we be worried about that? Have they had a change in ownership? Maybe they were bought out. Has their philosophy changed? Those are the kinds of sort of soft, intangible, qualitative criteria we look at. And then we also look at quantitative criteria, especially around performance and risk and what have you. Those are the things that go into our evaluation of the funds that we use on your behalf in your portfolio. And then these are the scorecards we produce, okay? And so this is your active equity managers. So this is Brown, like I just spoke about, Gelser Rising Dividend, Vanguard, and then so on and so forth. And then we have sort of 3 colors, as you can imagine, a green, a yellow, and a red, right? And we have qualitative reviews, quantitative, and then our overall. So as an example for Brown Advisory, their performance has been very good. They've been in all the right parts of the market lately because it's been very a growth-oriented market. And so the greens really run here really well. Now the Gelser Rising Dividend, it's a great long-term strategy, but we have a yellow here on short-term performance because dividend-oriented stocks in the last couple of years have been out of style, if you will. That doesn't make them bad. It just, we go through that from time to time. And so we put a yellow around that because the short-term performance has lagged their indices. Long-term numbers look good. But this is how we keep track of all these different strategies within your portfolio. I am not going to walk through each one of these. More than happy to talk about any of them. But safe to say, we don't see any problems within your active equity managers. They all have green, but we do have some notes on each one of them that we're watching. And in fixed income, very similar. We're very comfortable. Everything's in the green, and the scores look good. But we're also, looking at some elements and making sure everything looks okay there. And we keep things on sort of watch lists if we get yellows or reds, obviously. This is just some of your passive indexes. And then here's the Gelser non-traditional style. Now this got a couple more yellows. That's not to be unexpected. These are much more unique sort of strategies, if you will. There's a lot more elements to these strategies, and so there's more going on. Give you an example here. Diamond Hill. This has been a great long-term fund. They're based out of Columbus, Ohio. They buy stocks and they also short stocks. That they've had some portfolio manager and portfolio analyst turnover, which has given us some pause, and we've talked to them about that. And we're watching that, and they've had some unexpected performance. So we're watching that. So we put them on watch, and quite honestly, right now we're doing some manager searches to see if we need to maybe find a replacement for them. And like Gabelli as an example, that is a fund we just got rid of. Actually, we're in the process of getting rid of and moving on to a new fund. Some of that is not really around any problem with the performance of the fund or the people or the firm. It's just the style of the way they manage that portfolio. They tend to have large cash positions. And with interest rates anchored at 0 for the next 3 years, those cash positions are really going to be a drag on performance. So we've decided to exit that, just sort of thinking about how the markets are and looking forward a little bit. It might be one we get back into when short-term rates when they get better. But for the time being, we're gonna move out of that fund. So with that, there is a slide, and there's a lot of quantitative criteria. We don't expect you to go through all this unless you have trouble at night sleeping, but you can really see all the data that we look at behind the scene on each manager. So with that, I will wrap it up. We're at about 35 minutes now, and want to be mindful of the rest of your agenda. And if there's any other questions, we can answer for anybody.
More so
Thank
for
you.
Elaine. I know back in, I don't know, maybe March, April, could have been later in the beginning part of the year, but I had called curious because of the stock market and everything that was occurring. And I think we were 18% in the negative at that time. Do you feel comfortable with the recovery that we have right now from there? I know that there was a handful of sheriffs that were calling you and they were concerned about that.
Yeah. So yes, feel very good. Just to give you an idea, I don't think we have it here, but I believe you guys are almost back to your high water mark from February. So the value of the account peaked in February. We had the big, like you said, drawdown or decline, and it's come back. And this portfolio, I believe, is up, has recovered somewhere around 35 to 37% from the lows, if memory serves me right. I don't have that in front of me. So yeah, we're very happy. I think what I'm most proud of for the team, Sheriff, is that in March, as the market, it was the fastest decline ever in terms of from the top to the bottom. And we're leaving the office, going remote. The market is crashing, and the investment team, the advisors, did a terrific job of rebalancing all the portfolios at the end of March. And what I mean by that is we were selling some bonds and buying stocks when you need to, which is at the bottom. And then we did some excellent work in April and May to add some exposure to some areas of the market like small cap and high yield bonds that were really providing some terrific investment opportunities because of the declines. And so I think our execution was really, really good. And I think it shows. And like I said, it's hard to believe when you look at these numbers here on this page that we had a 35% decline in the stock market, right? And as you said, you were down 18% or so. Everything's come back nicely. And now we're looking at a year-to-date number of 8.25. So we're very pleased with how things go on. And the Federal Reserve helped everybody. They came in and sort of backstopped the markets and said, hey, listen, we shut down this economy, so we're going to help cushion the blow here. And as soon as they did that, things really started to move to the better.
Thank you.
Absolutely. You're welcome.
Okay, any other questions from the board members?
No, I don't think so.
Anything else?
Hey, Don, if you don't mind, can you switch the host back over to me, please?
Yeah, sure.
Thank you.
Absolutely. Where did that go?
Well, hopefully next time we talk, things will continue to be good. And the world
And
will
we'll
be.
meet in person.
Yeah, absolutely.
Yeah.
Yes, let's hope.
Okay, but that's it. Thank you very much, Elaine
Okay,
and
well,
Craig. and
thank
Don.
you.
Appreciate it.
Have a good holiday season and
too.
we'll be in touch and look forward to seeing you next year.
Okay, thank you.
Okay,
Thank
bye-bye.
you very much. Bye-bye.
Did I get you back there or no?
No, it's still showing you as the host. I clicked that instead of just allowing you to share the desktop. So you got to give that
Okay.
back to me. Otherwise, before you leave, it'll end the meeting, I think.
Yeah, I think you're right. I'm just trying to make sure I get you there.
I think
Sorry.
it should be near the mute options. I don't know if you're on desktop or
Yeah, I am. I'm just looking here to see. I
down in
can't.
the. Actually, you know what you can do is hover over my picture and right click the three dots that come up in the upper right. I think there's an option there to make host.
Oh, there you go. Yep. Thank you. I appreciate it. Yeah, there you go.
Yep.
You
Yep,
should
there we
well
go.
set.
Yep,
Okay.
perfect.
Take care.
Thanks.
Thanks, guys.
Okay,
Yep.
thanks, Don.
Bye-bye.
Okay, with that, we'll go ahead. Is Angie, you still there, Angie?
Yes, I am.
Bob, you're still there?
Yes, I am.
Okay. Let's go ahead and start the meeting for the Sheriff's Merit Board meeting for November the 18th, 2020. We'll first take attendance. I know everyone's here. Josh,
Here.
Bob,
Here.
Angie, Megan,
Here.
and
Here.
and Jim's here. So with that, I think Randy sent out a copy of the minutes for August 20th, 2020. If you've had a chance to review that, I'll take a motion to approve the minutes.
I'll make a motion to approve as submitted.
I'll second.
Okay, we got a motion to accept the minutes and a second. All those in favor, just say, hey, just say yes.
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 Yes. Okay, so it passes 5-0. New business, Sheriff.
I appreciate what everybody did to go through the promotional process. I don't know if that's going to fall right now. I'm sitting here looking through my stuff right now, flipping through a couple of things, but I appreciate everybody coming in, taking care of that. I guess we can kind of put these together right now. We got all the results back. We'll be making changes first of the year, putting people in new positions for the rank, but it took a lot of work to get where we're at right now. And we couldn't have done it without the people from Hamilton County Sheriff's Office and Morgan, and especially our merit board. I think it went well. We did miss you, Bob. We wish you would have been there with us.
I
but
appreciate that. I wish I could have been there too.
We understand, and I did send out a copy to everybody. I emailed it prior to the meeting of how everybody had fallen in that process. And if I can ask real quick, Jim, Josh, can I sign that and initialize by your name of the minutes to keep you guys from coming down? And it's also going to be the attendance sheet also for Brandy that I can do that.
I don't have a problem with it. Sheena, are you okay with that?
Sorry. Yeah, that's fine.
Okay, yeah, that's fine.
Does anybody have any questions about how people had fallen, either being a lieutenant or a sergeant on the testing portion of it?
Not this moment. I would just ask maybe Sheriff, you could send us all a copy of that. Email.
You should have it. I had Brandy send it out just a little bit ago.
Okay, all right. With that, is there, okay, any other, and I do appreciate too, everybody's attendance, and Bob, we understand, and you were very, very sadly missed. Josh really missed you a lot.
Yeah, I was still I appreciate that, but I was still expecting flowers or candy from the sheriff.
I left some on your front porch, so I can't speak. It may have been an Amazon theft.
I tried to send you some, but Josh said no. He
Okay,
was sad.
okay.
Okay, any other new business, Sheriff? Any personnel business?
Nope.
Okay, any old business need to discuss? I do have the new dates or the dates for 2021's meetings. They'll be February 17th, May the 19th, August the 18th, and November the 17th of 2021.
Are you gonna send that out? Because I didn't have a pen to write that down.
I will send it out.
Okay, thanks.
Any question on any of those dates or any issues with anybody?
No.
No, it's late, but hopefully by February, we'll be able to meet in person and
We'll see.
all this stuff will be over. I hope. So, okay, anything else, anything from the mayor board members, old business, new business, anything to discuss? Andy, anything from you? Okay, do we have an audience out there anywhere?
No.
Okay, with that, I'll take a motion to dismiss the meeting, adjourn the meeting.
I motion to adjourn.
Okay, you have a motion and a second to adjourn the meeting. It passes. Everybody, yes with that? Okay with that?
Yes.
Okay, well, passes 5-0. And everybody have a good Thanksgiving, whatever that may be, and Christmas, and we'll see you all in February, hopefully.
Okay.